All right, ladies and gents, good Friday to you all. Hopefully, you're having a wonderful day so far. If you're if you're having a wonderful day, hopefully, well, maybe there's an opportunity to trade, and that being with the non-farm payrolls. So let's go through. What I'm going to do is go through the preparation, expectations for the economic release, what's happened in the past. And if you don't know who I am already, my name is Tony, the head financial analyst at FinancialJuice. So just remember, the markets or the US stock futures close at 9:15 a.m. Eastern time. So just to bear that in mind. But let's get into it. We've got quite a bit well, not too much to cover compared to what we used to have. So what is non-farm payrolls if you're unsure with what it is? So it is the net amount of jobs created within the prior month. And you also have the household survey, which represents the unemployment rate. Okay, so you have two different surveys. You have the household survey and then the establishment survey. The establishment survey surveys 666,000 corporate and government work sites. And then you have a household survey where the unemployment rate is derived from. The establishment survey is seen as a more reliable one because that's, of course, getting data from the businesses of how many people they have on the payrolls or how many jobs were added by that company, or if there were less jobs added or any jobs at all added by that company. Then how does it affect the markets? Very simple. We've seen in the past non-farm within the tightening cycle by the Federal Reserve that when you do get hotter than expected data, that has William Reich, it is very satanic, isn't it? City says, hello, thank you, FJ, for the website. Thank you for your support. So one thing we've got to just be aware of is with how it affects the markets. Okay, yes, apologies for that. So how does it affect the market? So with currency, if you do get better than expected data, that plays into the hand of the Federal Reserve. We're looking to tighten more and making sure that the parts of the economy, such as jobs or spending, do start to come down in line with what the Federal Reserve wants to do to be able to then achieve their goals. So with the currency market, whenever you do get hotter than expected data, you do see an appreciation within the dollar in anticipation of tighter monetary policy or maybe higher rates from the central bank. Then the stock market, very simple. The opposite happens with the stock market. If you do see hotter than expected data, we've seen in the tightening cycle that stocks see a move towards the downside. They don't have an appreciation like they normally would when the economy is doing well and not within a tightening cycle. In this case, of course, they're anticipating that the Fed may have to hike for longer or be more hawkish with their monetary policy. And then for the bond market, very simple as well. If the bond data, non-farm payrolls data is stronger, or if it's stronger than expected, that will lead to bond yields going higher. Again, in anticipation of a higher rate from the Federal Reserve. On the flip side, you have, if you do get worse than expected data from non-farm payrolls, that will lead to bond yields going further down. The main reason at the moment, or what's still the prevalent reason at the moment, is that it's the expectation that the Fed has less to do, or maybe will pivot sooner rather than later. Considering we're more or less at the very end of the hiking cycle, markets and summary of economic projections from the Federal Reserve are expecting one more 25 base point hike before they decide to pause and then see what it does for the economy, and then whether they do pivot and start to cut rates. Maybe as what some traders are looking at, maybe as early as July, but that's yet to be seen. We do have some questions. The engineer says, is there recession fears in case of bad data? We'll kind of go through that. There's a piece by UFJ's Morgan Stanley about it. Yeah. Peak says, what about gold? Simple. If you think about intermarket correlations, if the dollar is stronger, then you expect gold to be weaker. Okay. Remember, gold is measured in dollars. So if the dollar is stronger, you have more dollars to spend, and gold becomes cheaper. And again, there's also the idea that the economy is doing well, and there isn't a need to go to the safe haven asset of going into gold. Now, so that's how does it affect the markets? So the indicators that are weighing in on sentiment. So inflation ticked down to 6% from 6.4%. PC price index year on year was at 5% compared to 5.3%. GDP quarter on quarter Q4 was at 2.6% versus the third quarter of 3.2%. Unemployment rate at 3.6% versus 3.4%. The ISM Manufacturing Employment Index, which is important to keep an eye on, went down to 46.9 compared to 49.1. ISM Manufacturing PMI ticked further down into 46.3 compared to 47.7. ISM Services Employment at 51.3 compared to 54. Services PMI was a 51.2 versus 55.1. So remember, with the ISM data, whenever a data that's 50 or above shows that that area is in expansion. Anything below shows contraction. Anything lower than 47 shows that area of the economy is more or less in experiencing experiencing a recession, and that there is some bad stuff that's going on within that sector. And there's a lot of work to do for those businesses to climb back out. But a lot of what this bad data that we've seen in the recent week or so has kind of spooked traders as to whether, okay, data's becoming bad now, and we probably want to look for good data to kind of keep things trudging along. But then there's the other thought that the central bank might have to pivot sooner rather than later and start cutting rates sooner. So there's also that thought that plays in mind as well. Jolt's job openings at 9.931 million compared to 10.563 million. And the employment costs at 1% versus 1.2%. ADP employment change was at 145k compared to 261k in the prior result. And then if we look at the triggers for the economic release then. So we can see that according to analysts and their estimates, so they're looking for, non-farm looking at a high estimate of 300k with a low estimate of 150k. So you're looking for about a 70k deviation. What economists are looking at more or less on either end, or 70 to 8k deviation. The US unemployment rate seen with a high estimate at 3.7% with a low of 3.5. Average hourly earnings, again, that's going to be quite key for the inflation talk and what the expectation for the Federal Reserve might be. If wages tick up higher, that could muddy the waters for how the markets trade, or make it clear that if earnings are higher than expected, that means the Fed might have to do more work, and you could get one straight move towards the downside for the stock market and for the upside for the dollar instead. But light trading today, so we'll see how big these moves are. Private payrolls with the highest mint of 280k and a low of 175k. And then investment bank views. So Societe Generale sees non-farm at 215k with the unemployment rate remaining unchanged. JP Morgan sees 255k, seeing unemployment ticking down 3.5. TD Ameritrade sees non-farm at 270k with the unemployment remaining unchanged, as does Morgan Stanley. They forecast non-farm to come in at 240k. So everyone else on this list except Societe Generale expects a higher than expected figure compared to the forecast of 230k. So they're still expecting a labor market that is still not as hot as what it was in the past, but still quite solid and robust from what we've seen. The previous report then, so in February, notable job gains occurred in leisure and hospitality, retail trade, government and healthcare. Employment declined in information and in transportation and warehousing. Employment showed little change over the month in major industries, including mining, quarrying, and oil and gas extraction, manufacturing, wholesale trade, financial activities, and other services. And then Fed and government views, what do they see as well? So Fed's Bullard expects inflation to be stickier and sees a strong labor market. Powell said that since the last meeting, economic data has come in stronger than expected, but they think that the recent banking events will result in tighter credit conditions. So this is quite... So, you still have the lingering effect of the lingering effect of the market, of the banking crisis fallout with SVB and how Credit Suisse was affected as well, also with First Republic and Signature, all of those places having issues. Powell had said on March 22nd that a couple of weeks ago, they thought that they would have to raise terminal rate before the banking stresses. So there is the thought that there's more dovishness that is expected to creep through or come through in strong full force from the Federal Reserve. But again, it depends on... We haven't seen any other banking news that's been as big as SVB or Credit Suisse. More or less, it's been very quiet on that front. So the sentiment is more or less has shifted to what does data look like for the economy now that central banks are more or less where they want to be with their terminal rates. How does the economy fare? And then we'll take it from there. And then if we carry on, March 24th, Barkin said the labor market is tight and inflation is too high. So this is the point I wanted to kind of go through, which is the bit at the bottom with UFJ's Morgan Stanley, Tokyo's Yono. So BMO's Gallo said that they would lean toward the Fed becoming more supportive over the course of the second half of the year. Maybe not easing in Q3, which is already priced in by the rates market, but possibly turning a bit more supportive, at least in its tone. So just what I was talking about with earlier on with Powell and his comment that he made on March 22nd, that the banking crisis or the banking fallout has made it a bit harder for the Federal Reserve to maybe lean towards hiking rates by more than they would want to, even though they are quite high and they've been hiking rates quite quickly over the last year or so. So that's one thing just to be aware of from BMO's Gallo. Now, UFG's Morgan Stanley, Tokyo's the chief FX strategist, say market reaction to employment statistics poses an asymmetric risk because US economic data has been poorly recently, i.e. this week and over the past month or so. Any good surprise from Friday's report would be viewed skeptically, whilst a negative surprise would support market participants' fear that the US economy is slowing. So, what does that mean? Let me clarify that for you and make it simple. If data is great, market's going to think, all right, we don't believe it's going to last that long. If data is bad for non-farm payrolls, then the markets are going to think, yep, the economy is slowing down. That's it. Okay. That's what, just to summarize that there. So market reaction wise, what that means is we have two scenarios. We have the first scenario where data comes in better than expected, and you see a flash move towards the upside in the dollar and a downside in the S&P 500. But you could see a quick reversal happening. Okay, if we're going with the thought that the markets might view the data, positive data, skeptically. The other side is that if data is, let's say data is really, really good for non-farm payrolls, that you could see an extended move from each of the assets rather than a quick flash in the pan whipsaw reaction. Okay, and actually, well, the third scenario is if you do get negative data, that the traders will still be in that mode of, negative data. The central bank has got to do less work than expected. Inflation is also coming down nicely within the Federal Reserve's expectations, or towards the Federal Reserve's expectation as well. So that means that if the economy is slowing, if inflation is slowing too, the Fed has less work to do, and that could lead to a boost or bullish market reaction from the stock market instead, and a bearish reaction from the dollar. Flip side to that then is if the data is quite bad and traders are looking as to whether there might be a recession, you could have some of those traders creep in and think, well, maybe I shouldn't hold on to, maybe I shouldn't be, be bullish in the stock market. Maybe I should, or even the dollar, maybe. And actually, they'll flip their position from buying the S&P when data is bad to actually selling it instead. That's another thing to be aware of. So you've got 4 different scenarios there, 2 on each side. Okay, that's something just to be aware of. But from deviations, what we've seen is that the markets have, when the data has been worse than expected, the stock market has seen a bullish reaction, and the dollar's seen a bearish reaction, and then of course, and vice versa. So this is the last market reaction that we had seen last time around on March 10th. Bear in mind, you had the Canadian employment change data too. So there's also that traders were kind of keeping an eye on as well. But let's have a look at the last market reaction that had happened. So this is about 10 seconds before the release that we'd seen last time around. And we can see we can see is that the S&P, so there was a initial flash move down, and then boom, data comes out, and then you see a quick jump on the S&P, and then it goes back down. So there's a lot of whipsawing that had happened basically, but where the S&P ended up, it was 65 ticks towards the upside. And after about 10 minutes of trading, it was 77 ticks up. The NASDAQ, same story, up 316 ticks. And then after about 10 minutes of trading, up 228. And the Dow was up 110 ticks. And then after about 10 minutes of trading, was up by 122. So if we just kind of skip across and see what we have. Okay, so that is it's more or less the market reaction that we had there for non-farm payrolls last time around. So the dollar, so this is the key thing. The deviation amount we were looking for last time was 100K for the non-farm payrolls figure itself. We didn't get 100K deviation. We got an 86K deviation. If I bring up the deviation for you here that I've put down. Okay, so here we are. So the deviations then for the economic release. If you're not familiar with when I say deviations, Tony, what are you talking about? You can clarify? Yes. So the deviations represent how the markets react to the economic data that comes out and how big the reaction is. So the figure here represents, if you can see here, the initial market reaction going to the wick of the candle, capture the full movement, and then this represents the movement 10 minutes after the release. Again, this is all on a 1 minute time frame that we're looking at the data here. And again, as I said, 10 minutes after the release, the S&P was up 77 ticks. Okay, so that's what the deviations are all about. Just so you can gauge how big a reaction you could expect depending on what the figure is. When we've seen that, we haven't seen that much if the deviation hasn't been met, or has just kind of eclipsed the forecast figure. The stock market has seen in the past an appreciation rather than a depreciation. So if we go back to the 2nd of September again, and when there wasn't too much of a deviation, hopefully you can see me highlight that there. Hope you can. Back on September 2nd, if I just do that better, you can see that the dollar didn't like that, but the stock market did take to it. So again, same thing again. You want to keep an eye out on, if we do see, but when you do see a blowout figure like we had on the 3rd of February, where we had a 329k deviation, right, where it came in at 517k, then you see big heavy move towards the downside. So I think we're still looking at 100k at least for a decent market reaction. And then anything, if that's either way, whether the data is good or bad for non-farm payrolls, so I should say higher or lower than the forecast by 100k for non-farm payrolls. Don't forget, if you are watching this video, to share with your fellow friends and traders, get the word out there. We've also got to do a bit of summary of a bit of an analysis after the reaction happens, and then see what else there is to kind of keep an eye on. But yeah, so that was so if we're looking at the past two reactions then for non-farm, if you do get data that's more in line with expectations, you could see the stock market seeing appreciation rather than depreciation. And if the data is stronger than expected with non-farm, then you would more or less could see the dollar seeing a bigger move, a bigger continuation of a move towards the upside. So 100k is what we're looking at. Okay, analysts are looking at about 70 to 80k deviation either side for non-farm. Now, when we had the Canadian employment change, they were looking at a 30k deviation, but the markets didn't move that much. So that's why I'm always a little bit skeptical when I look at what analysts are trying to look at, or economists are trying to look at. But historically, that's what we're kind of maybe looking to aim to do. All right. So, and the reason why I say 100k is because of how the last month data, we had an 86k deviation, but we didn't get that. We had the opposite reaction that had happened. All right. Yeah, so ADP is private data. It's not from government data. So when you look at private payrolls, non-farm includes government payrolls as well. And so that's basically, combining those together, and also the data, the way it's collected too. And non-farm has a bit more of a reach compared to ADP as well. So that's another reason why and it's released by the government, so it's more official too, compared to the ADP data. Some people look at the ADP data. Let me just talk about this before. I used to talk about it in the past before with ADP data, but some people, a lot of people try and take ADP data as an indicator of what non-farm payrolls is going to be. But historically, there hasn't been a very strong correlation with ADP employment data and non-farm. So those who say, yeah, if ADP is stronger than expected, then non-farm payrolls is going to be big X. Hold that up. Hold those two hands up. Big X. Right? That's not always the case. So you just got to be careful. You can use it as a way to kind of, add to your analysis that, okay, if ADP is stronger than expected, there is more of a chance that non-farm payrolls might be stronger than expected, but that's only the private sector. You can't forget the government side as well. That is also included. So that's another thing just to be aware of too, with the non-farm data and the ADP employment data. Hopefully that kind of answers your question. Yeah, so question 4 says, so Vasily says, what's the difference between Financial Services PMI and ISM Services PMI? Key difference is the S&P Services PMI represents, it doesn't go into as many industries as the ISM Services PMI does. Okay, the S&P Services PMI focuses a lot more on just services rather than maybe, those in, let's say, those in mining who are providing services for other businesses. It doesn't have that much scope. Although it measures more businesses, the scope isn't as big as the ISM report. So the ISM being released from the Institute of Supply Management is seen as the bigger report because it's representing more industries in the non-manufacturing sector. So you get both reports are good to keep an eye on what the economy is doing. But it just depends on what you focus on more, the most, and what traders are focusing on more. To be honest, traders are focusing on both. It's down to you, what you want to focus on. But one gives you a broader picture, but the other one has interviews or surveys more businesses compared to the other one. Data is all how you take it and how the markets react to it, and what you do with it. There's just like the CPI report. There's it's a very accurate report because of the way the data is collected, right? And then you have the non-farm payrolls report, the establishment report. Okay, it's collected that bit of data for the non-farm payrolls figure itself, collected from businesses and how many jobs that they've added or how many people they have on their payrolls. Then that data, as soon as a prime month is done, the following week in the new month, then the data is released. So it's not just about the data itself, but it's also about the timing of when that data is released. There are so many things about economic releases. And I've actually, to be honest, got a video to talk about how to trade economic releases. Okay, if I just bring that up for you, I'm going to try and do it as quickly as I can. We've got about 3 minutes left on this here. Let me get up for you, because I think that'd be very useful content for people to understand what to kind of expect. I've got it here. If I can find it. Okay. What I'll do is I'll link it. Very soon. Okay, what I'll do is I'll link it in the video, post the release. We've got about a minute left now to go for the data to come out, or less than a minute. That's a shame. Let's get TICKSTRIKE running. Okay, let's see what happens. Okay, about 10 seconds. All right, so the dollar's already moving before the data's come out. Okay, let's see what's going on. 236K, 236K, higher than the forecast of 230K. Unemployment rate 3.5%, 3.5% lower than the forecast of 3.6%. Private payrolls 189k, 189k lower than the forecast of 220k. Okay, so seeing the dollar move towards the upside here, alongside the S&P as well. So, okay, of course bonds are down. Let's see. Oops. Okay, hold on. So get rid of that. No, that's the wrong one. Let's do GPUSD. Sorry, I should have had that one there. Okay, so what does this market reaction tell us? So what this tells us, now that both these, you can see both of them moving in the same direction, the S&P and the dollar, even though there wasn't that much of a deviation, the unemployment rate fell by 0.1%. Let's see, what was US average hourly earnings was 4.2%, so lower than the forecast of 4.3%. Manufacturing payrolls was better than expected. Labor force participation was better than expected. Average work week hours was worse than expected. So, if you want to take it this way, so you could say that maybe traders are maybe looking for more positive data from the markets. Now, if we're more or less towards the end of the Federal Reserve's hiking cycle, although this dollar move or dollar yen move isn't lasting, it might not. It's not as strong as what we're seeing in the stock index. Have a little look. Let's see what the dollar yen do. So jumped. So whoops, it's about 76, about 70 pips towards the upside there. On the dollar yen, 70 pips there. S&P, let's have a look. Okay, it's about 30 ticks, so not really a big, great move from the S&P. If I bring up the NQ, see what the other stock indexes are doing. Let's have a look. Yeah, not too much of a reaction. It's just it probably is just no one's here. But people are here in the currency market for sure. It's 115 ticks towards the upside. So that's the dollar yen. So cable. Let's have a little look here. So there was I want to see what the heck this was. Okay, so it's about 22.7 down, but then pips down. But then if I look towards the upside, notice that was a flat reaction. So yeah, I think it could be that traders are looking for positive data for both economic for both the dollar and the S&P. That's the first time, actually, if we're looking back at the deviations, that they moved, the dollar and the S&P moved in tandem from the non-farm payrolls data in a very long while since before the hiking cycle from the Federal Reserve. So if we go back to here. So 2 and 3 chance of a May hike after the jobs data. I think that's what I heard from our boys on FinancialJuice. So FinancialJuice, let's talk about it. So live voice and text service. If you're not familiar with what a live voice and text service is, there we go. So Fed swaps show odds of a May hike are now above 2 and 3 after the jobs data. So if you're not familiar with what a live voice and text service is, it basically provides you with the news, the global news of what's going on in the world that could have an effect on the markets. And generally, a lot of the time, markets are driven by news, and then it's down to your technicals and then how you want to play the markets and then the news. But that's what so live voice and text service is there, particularly for your day trader, to help manage your risk, understand why the markets are moving in a certain way. Okay. And then be able to capitalize on potential trades as well that may come through from headlines that you may think, okay, that's important. I need to do something with it. But that's what a live voice and text service is. Now, FinancialJuice, what we have on our website is, if I make this a big screen here. So we have the live voice that appears here. And then we have the news feed that appears through here as well, with the headlines from different, maybe there's Fed's Powell who says something, or maybe there's Biden, if he's not asleep, says something. You have your economic data, economic calendar here on the left-hand side of your economic data, so you can keep an eye on that. If you're a pro member of FinancialJuice, of your pro user, that's all in real time, not just the economic data, the news feed, or the voice feed. It's everything's in real time if you're a pro user of FinancialJuice. So again, remember, a live voice and text service is something that only a lot of the big boys have access to. You don't really get, retail traders may not have been exposed to it. They may have heard of it, but not really used it that much, or maybe not used it at all, but know what it entails. So what we want to do for you guys is you can sign up to FinancialJuice with the free version, okay? And then you can kind of gauge what FinancialJuice is like for you, whether a live voice and text service works for you. If you do decide to go to, going straight to pro, make sure you create an account on FinancialJuice first before you pay. Otherwise, it causes issues with account setup. Once you've created an account, go to email, verify the account that you have, go back to the FinancialJuice site, select the payment, select the subscription that you would like. Once you've done that, then log out, then log back in again, and that acts as a verification that you are now a pro member, and then you get this beautiful site. This is what you get. Again, everything you need is all in one place. Your news, text, your voice, and your economic calendar here with economic data, all in one place as well. You also have access to our news desk if you're a pro member as well. If you're on the light version of FinancialJuice, there is a delay. There are adverts that play with advert banners. As I said, there's a delay to the website as a whole. It is still useful, if you want to capitalize on what the markets are doing as quick as possible, as I said, particularly if you're a day trader, this tool is another tool to add to your assets, right? That you have or your toolbox. But if you're not ready to go to FinancialJuice Pro just yet, that's perfectly fine. Sign up to the free version of FinancialJuice. It's still quite useful. Get an understanding of how a live voice and text service works. See how it kind of works for you, and then make your decision as to whether or not you want to go pro or not. But there's even a 7-day free trial of the pro version. If you do decide to go with a 7-day free trial, then good luck with it. All right, so that's FinancialJuice, and then we have TICKSTRIKE here. So TICKSTRIKE, if you're not familiar with what TICKSTRIKE is, Vasilis has been using FJ for years now. When I will grow up, definitely going to sign up for a pro version. You do that whenever, like I said, whenever you're ready, then you do that whenever you are ready. Now, TICKSTRIKE, if you're unfamiliar with it, it allows you to measure order flow within the markets, visually and audibly. Okay. Or another way to put it, it gives you an indication of how strong the buying or selling momentum is within different assets, within Forex, crypto, futures, and your internals. Okay. It's like your VIX or your ADD. And this is what we call the ticker box, or what we have here. If we bring up the ticker here, let's see. Okay, that's a bit strange. Why wasn't it? Okay. So with TickStrike, what it does, if I show you this little ticker box here, so if we're looking at the dollar yen, you can see it's got a number, a plus sign, and a color. What you want to focus on is the symbol and the number. So the plus symbol shows you that there's buying momentum that's going on, and the number shows you how strong that momentum is. Okay, and the minus symbol, of course, is the opposite. Now the number here shows you the sensitivity, and you have a scale going from 1 to 15. 1 is the most sensitive to market reactions. So as you can see, when there's a little bit of buying going on, then it will give you the visual alert. And you can chop and change this however you want, the level of sensitivity. If you go all the way to level 15, that's the least sensitive to market reactions. Only when there's a big amount of momentum of buying or selling that's going on, only then will TickStrike pop up for you. But again, that's something you can chop and change and have a play around with and see what works for you. So I'm going to put that, there's also a link to that there in the chat as well. Okay. And then finally, the deviations for the economic release. Okay. So this bad boy right here. So all this data has been collated together all in one place. A history of how economic releases have had an impact on the markets. If you were like that and you're thinking, well, how much does it cost? I'll tell you how much it costs. Nothing. It's free. It's completely free. All you got to do is sign up to the MACROACE mailing list, which I'll put in the chat here for you. And you can get it completely free as well. And including that MACROACE mailing list, so one email is sent every Sunday. And that includes the deviations for the upcoming economic releases for that week with the live streams as well. And then also at the same time, you get the expectation for the US, Europe, and Asia session and a summary of the weekend news, which is quite short. It's not big, huge, massive paragraphs. I like to keep it simple because I talk to you guys here in more detail about what to expect. So I like to keep it nice and light. And it's a Sunday, so you don't want to have too much of a heavy reading session going on, but just to set expectations for you there as well. Now, that is the economic release for you. Then finally, unusual activity. So if you like trading on high probability stocks, futures, FX, and crypto breakouts in real time, then you can use unusual activity to do that. So next week, CPI, PPI, baby, the inflation prints for consumers and producers. That concludes MACROACE. Thank you very much for joining me. Don't forget to like the video, share it, subscribe to the channel, get the word out there, get that word pumping. If you've enjoyed the content, great. And I will see you guys next time. City says, so much useful data for free. Feels like cheating. Hey, I mean, I'm putting that out there for you guys. So I think you guys, deserve this. Thank you, Yasan. Thank you, Lee Sheehy. Saying thanks, Tony. Have a good weekend. Have a great have a great Good Friday too. Sludge says, take care, mate. Yes, take care, you guys. I will see you next time. Afuera. Goodbye.